Hi, students. So because of recent events that have been going on in the market, and I'm sure you know what I'm talking about, I decided to put together a quick little bonus lecture so we could talk a little bit about what's going on. So because this is an asynchronous course, this is something that we would probably normally be talking about in class. Just somebody would bring it up and we would discuss it. But because we don't have that opportunity, everything's pre-recorded. But I did think that this was something that's, important enough to be worth talking about. I decided to just record this video so we could go over what's going on a little bit, just so you guys have some kind of grounding, because it does relate, of course, to what we're covering in the course. Now, of course, this is all something that's still developing, right? So I'm recording this on Thursday, January 28th. And so whatever happens after this, obviously, I can't be sure of, right? So most likely, I'm going to try to put this on the Blackboard page as quickly as I can. And then afterwards, maybe at the end of the semester, after we've kind of figured out everything that's happened, then maybe I'll clean this up and I'll do a kind of a cleaner final version, and then that will be carried over to future semesters. But let's just talk about this a little bit now. So obviously, what I'm talking about is the thing with GameStop and the Reddit Wall Street Bets subreddit, right? So if you're not familiar, this is a GameStop. They're a store that sells video games. You'll find them in malls, shopping centers all over the country. So GameStop is particularly well known because they're pretty much the last remaining brick and mortar video game store, right? And it's because even though the gaming industry obviously has grown a lot in recent years, they've mostly shifted toward digital distribution. So because, well, this cuts out the middleman here being places like GameStop. Now, the one thing that you can do, the one advantage of still selling physical game discs is that you can trade them, right? That you really can't do with a downloaded game. And so that's really always been GameStop's main business, right? Is buying and selling used games. If you've ever been to GameStop, you'll know, right? That GameStop, their MO is that they take customers' trade-ins, they pay them very little for them, and then they turn around and they resell the same stuff for a lot more. So this is actually kind of ironic, right? Because, and we'll get to this later on in the course, what GameStop is doing essentially is they're acting as a market maker, right? They're offering to buy and sell at the same time, and they're collecting a little bit of a spread for doing this. Now, part of this is because, well, the customers don't really know any better, but this is justifiable on some level, right? By by providing this service, by providing this market making service, right? GameStop is assuming a lot of inventory risk, right? They're taking on a lot of games that customers are trading in that they may not be able to sell. So to some degree, they're justified in charging a little bit more, well, a lot more, when they resell these games, because they know there's a lot of games that customers will trade in that they won't be able to sell. Okay. So that's kind of ironic given basically what GameStop acts like an investment bank, right? They act like a big Wall Street firm, right? They're making markets, they're buying and selling stuff, they're moving stuff around, right? This will be ironic given what happens to them later on. Now, what you need to know about GameStop, right, is like just like all other retail stores during the pandemic, GameStop got hit really hard, right? Obviously, because there's a lot fewer people going shopping. People, it's safer, easier for people to just download games over the internet, right? So, and GameStop, there's some retailers that have adjusted to this better than others. GameStop, now we're not, this class is not going to be a class where we kind of talk about, the specifics of certain companies or like what kind of strategies they're pursuing, but there's nothing that you see from GameStop that would give you any indication that they're really have any kind of plan going forward, right? What are they going to do about the pandemic? What are they going to do about, the competition from digital downloads? There's really no reason to believe that GameStop, has some kind of life going forward, right? That, they're kind of just one of those companies that's, how shall we say, kind of slow walking their way toward obsolescence. So Let's set that up right there. Okay, GameStop is kind of an outdated company, right? They're kind of behind the times, and the market knows this, right? The market has targeted GameStop as a company that's particularly vulnerable because they have not adjusted well to kind of the new economic reality. Okay, so let's keep that in mind and let's talk about the other part of this equation, which is short selling. So, short selling is a topic that we will touch upon in the weekly lectures, but actually, unfortunately, we never actually cover it in exhaustive detail. So, actually, this will be a good opportunity for us to do that here. Okay? So, let's think about what trading is. Whenever you take some type of position on an asset, what you're doing is you're expressing a belief, right? All trades are going to pay well in certain states of the world, and they're not going to pay so well in other states of the world. Right? So whenever you take any kind of position, any kind of portfolio, there's kind of a win condition and a lose condition. All right. So when you are taking a position on an asset, you're effectively expressing a belief. You're saying the states of the world upon which this portfolio will be good for me, I'm betting on those. I'm saying those are going to be more likely than what the rest of the market thinks, right? So every time I trade, every time I establish a position in any kind of financial security, I'm expressing a belief, okay? So if you think a stock is going to go up, you should buy it, right? That's called taking a long position, right? If I think the stock is going to go up, I benefit by buying it. Therefore, by buying the stock, I express the belief that I think it's going to go up. Now, what if I think the stock is going to go down? Well, if I had shares, I should sell them, right? So if I think the stock is going to go up, I should buy. If I think the stock is going to go down, I should sell. I mean, it's obvious, right? Well, here's the thing though. What if I don't have any shares that I can sell? What if I don't have any shares in GameStop and I still think the stock is going to go down? What can I do then? Well, one thing I could do is I could buy some shares just so I have shares to sell, but that's obviously silly, right? I'm thinking the stock is going to go down. Why would I buy first and then sell, right? So, what if I sold shares that I did not actually own? Okay, so this is like that infamous story about the guy who sold everybody the Brooklyn Bridge, right? I don't own the Brooklyn Bridge, but I'm selling it to you anyway, right? I don't own shares in GameStop, but I'm going to sell them to you anyway. This, of course, is short selling. So on the 12th of January, GameStop was worth about $20 a share. Okay. And most people thought, I don't want to say most people, a lot of industry people thought that $20 a share was too high and that it was going to go down. Okay. The price is going to drop soon. So, how would I express this sentiment? How would I express this belief that the GameStop stock was going to go down? I would short sell. So, how does short selling work? What I'm doing when I'm short selling is I'm borrowing shares to sell to somebody else. Okay, so for example, let's say I borrow 100 shares from my broker. I'm going to sell them for $20 a share. Okay, so I'm going to make $2,000 right away, but I took a short position, right? I owe my broker 100 shares. So I have negative 100 shares of the asset, and I need to close out that position at some point. I need to, at some point down the line, buy 100 shares so I can return them and close my position. So if my prediction is right, the stock price will go down. And if I have a short position, it's advantageous for me that the stock price goes down, right? Let's say the stock price goes down to 15. If the stock price goes down to 15, I'm able to buy those 100 shares for $15 a share. So I sold for 2,000. I have to buy back, but only for 1,500, which means that 500 is a profit for me, right? 500 minus whatever transaction costs I have to pay, but let's not even think about that for now. All right. So if I am short selling, what I want to do is I want to sell high and buy low, right? It's like the usual paradigm, but I reverse the order of operations. I sell at the high price first, and then when the price goes down, I'm going to buy. That allows me to close my position so I don't owe any more shares, but I've netted the difference in price as a profit. So this diagram just shows the mechanics of short selling. So once again, sell high, buy low, right? You want to sell when the price is high. You're expecting the price to go down. When the price goes down, you're able to return those shares to your broker at a lower price than what you sold for initially. So short selling is interesting because it creates a number of somewhat odd situations. Okay, so for one thing, for every share that you short, there are now two different owners. There's the original owner. The original owner is the person that you borrowed the share from, or more likely, the client of the brokerage that you borrowed the share from. So the brokerage just takes a share from one of its clients and lends it to you. That person most likely does not even know that their shares are gone. Okay. And then you have the person that you sold the shares to. The interesting thing is, right, that this new owner is actually the actual owner of the shares, right? The person whose shares were lent out, who may not even be aware of that transaction, actually does not have any shares anymore, right? They don't get paid the dividends. They don't have any voting rights. It's the new owner that has those things, okay? More pertinent for the current case is that when you short sell, you can potentially suffer unlimited losses, right? Because when you're short selling, you want the price to go down, but the price doesn't have to go down. The price could go up. So what happens when the price goes up? You're going to lose money. And unlike with taking a long position, when you take a long position, the one good thing is that, well, you can't lose more money than you put in initially, right? Because no matter what happens, the stock price can't go below zero. So at most, you will lose all of the money you put up. You can't lose any more than that. If you short sell, though, it's possible to lose more than what you more than the value of your initial trade. In fact, it's possible to lose a lot more than that. Okay, let's think about how that works. So when you short sell, what you need to do is you need to maintain a margin account. Okay, and the margin account is basically there to keep you honest, right? Because we don't want people to just be able to short sell and just leave a short position open forever and never repay those shares, right? So the margin account, the value of that is going to fluctuate in accordance with the gains and losses in the market. So that's what it's called, mark to market. And we'll encounter margin accounts later on when we talk about derivatives. So usually the margin requirement for short selling is 150%. So you need to deposit all of the money you made from the original short sale, then another 50% of that from your own money. Okay, so for example, if you were to short 100 shares at $20 a share, you got to put 2,000 in the margin account plus another 1,000 of your own money. So you start with a value of 3,000. Then that margin account is going to be marked to market. So when the price of the stock goes up and down, the value of your margin account will change to reflect that. Specifically, because you're short selling, when the price of the stock goes up, your margin account is going to go down. So for example, if the price goes from 20 to 35, you're going to lose $15 a share from your margin account. So your margin account is going to drop from 3,000 to 1,500. If the price keeps going up, if the price goes up to $50 or more, the marginal account would drop to zero. And so you'll be subject to what's called a margin call. So margin call means that, well, your margin account just got wiped out, which means you have two options. You can either put more money in the margin account or you can close your position. In order to close your position, you need to immediately buy shares at whatever the market price is in order to close out your position. Okay, so imagine what happens if a bunch of short sellers are subjected to a margin call at the same time. A bunch of people had a short position, but the price went up high enough that their margin accounts were wiped out. They have to either close their position or they have to put more money in the margin account. Imagine what happens, right, if a bunch of people need to buy shares at the same time. This is going to cause the price to go up, right? So the price went up. That means a lot of short sellers have to deal with a margin call. That means a lot of them are scrambling to buy shares. And all of those people trying to buy shares right away, that's going to bid the price up. But what's going to happen when you bid the price up? You're going to have more people whose margin accounts get wiped out, more margin calls. So there's kind of a vicious cycle going on here, right? And this vicious cycle is called a short squeeze. Basically, if you have short sellers, when the price goes up too high, it's going to be hard for them to maintain their short position. And if they're trying to cover their short position, they're scrambling to buy shares. That's going to cause the price to go up even more. That creates a vicious cycle. Okay. The alternative is, well, instead of closing my position, I can maintain my short position. I'm going to say, you know what? I don't care what the price of GameStop is now. It's still going to come down eventually. Let me just put more money in my margin account for now. I'll make it back later. You could do that. And remember, because the losses from a short sell are potentially unlimited, you could end up sinking however much money you can imagine, way more than the initial size of your trade, into the margin account just to keep it going. And as the saying by Keynes goes, the market's going to remain irrational longer than you can remain solvent. So if your strategy is, you know what, I know that in the long term, GameStop is going to come down, so I'm going to hold my short position. I don't care how much money I have to put into my margin account. I'm just going to hold it, and then eventually the price will come back down and I'll be good. Well, you can try that, but as we shall see, you're going to be in some trouble if you try to do that, because a lot of crazy stuff can happen in the short term. So now let's connect all the dots, right? We have GameStop. GameStop is a struggling brick and mortar retailer that's having trouble adjusting itself to a changing industry. So a lot of investors are bearish on the stock, right? They think that GameStop is a bad stock and it's going to tank, right? So they hold a lot of shorts selling going on with GameStop. So much, in fact, the short interest on GameStop at one point reached over 140%. That means that there were more shares being sold short than actually were being floated. So how was this possible? Well, what could happen is that shares are being lent out to be short sold, and then those same shares are then lent out again to be short sold again. And this could occur as many times as you want. But when you have a short interest over 100%, that means on average, each share of GameStop was being short sold almost 1.5 times. So there was a lot of short selling activity going on with GameStop. Certain investors, so Melvin Capital was probably the most famous one of those, were very bearish on GameStop. They were almost certain that it was going to fail, and therefore they had, very large short positions. They were really banking on GameStop to fail. Now, in finance, we talk a lot about efficient markets. Later on in the course, we're going to have an entire chapter dealing with that. And so efficient markets, just to give you guys a little bit of a primer, is this idea that markets aggregate all available information, and therefore that the market price always gives you kind of, the best possible estimate of what the true value of an asset should be, okay? The thinking goes, right, that if a stock is undervalued, people are going to buy it. If it's overvalued, people are going to sell it. So over time, the price of a stock is always going to converge to the true value. However, this does rely on the assumption that markets are competitive, right? You don't have anybody, so you don't have anybody colluding, anybody kind of trying to fix the price, and you don't have people trading on private information. All those things can mess up markets a lot. So when you're talking about big blue chip stocks, that's a pretty safe assumption, right? But when you're talking about kind of really obscure penny stocks, you know, those stocks, there's a lot of information about them that's technically public, technically is out there, right? If you just look up some random penny stock, all of their information is out there, just that people don't think about it a lot, right? So it might as well be private, which means that certain people can utilize public information as if it were private information and then use that in order to manipulate the price of a stock. So the most commonly recognized form of this behavior is what's called a pump and dump scheme, okay? So what do you do when you want to do a pump and dump scheme? You find a stock that not many people are thinking about, just something random. And what you do is you buy up a large number of shares. This is the pump, okay? You buy up as many shares as you can. That's going to push up the price. And more importantly, it's going to attract the attention of other people. Other people go, oh, well, this random company that no one's ever heard of, it's really surging. Maybe I need to get in on this action too. So you buy up a lot of shares, you pump up the price, that attracts more traders, and that's going to push up the price even more. So the price is going up and up and up and up. For what reason? People aren't really thinking about it, right? It's like, okay, well, the stock is really, there's a lot of momentum here. I don't know why it has so much momentum, but you know what? I need to buy now. I'll think about it later. Then when the price reaches a peak, that's when you do the dump. That's when you sell everything. Okay, you sell everything at the peak. And then the same thing happens in reverse, right? You sell, the price goes down, everybody else sees the price going down, everybody else tries to sell at the same time too. This caused the price to crash. So with a pump and dump, the original kind of schemers, right, the con artists who plan the pump and dump, they're able to buy low and sell at the peak. Everybody else gets screwed over, okay? So if you ever watch Wolf of Wall Street, this is exactly what they were doing, okay? So when you're talking about a pump and dump, think about the kind of a shady group of con artists, right? You have to keep your circle small because, if everybody figures out that it's a scam, then the whole thing falls apart, right? What that means is that it's generally hard for kind of a group of random people, it's hard for the general public to manipulate the market, right? You can't just have, a bunch of average Joes initiate a pump and dump because they have no way of coordinating it very well, and they have no way of hiding it very well, right? So, or at least this is what everybody thought, right? So I'm sure you guys all know about Reddit. Reddit, there's a lot of different communities talking about different topics. Finance, obviously, is something that's big on a lot of people's minds. There's a lot of subreddits that deal with finance, right? So you have, investing, stocks, personal finance, whatever. These types of subreddits tend to approach it from a more serious direction. In fact, what they talk about in those subreddits is not that different from what you're going to learn in this class, right? You'll hear a lot of highfalutin talk about, oh, well, you got to maintain a well-diversified portfolio and blah, 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 right? So that's kind of one way that Reddit approaches finance. But then in contrast to those places, there is, of course, Wall Street Bets. All right. And so with Wall Street Bets, the question you got to ask is, well, what if we turned a stock into a meme? Now, I'm going to admit, I never really spent that much time on Wall Street Bets myself. But if you spend any time on Reddit, if you spend any time on the internet, you'll have definitely heard of them, right? They are just these crazy idiots who are just have way too much money to play with, and they're just always making these ridiculous bets, these kind of crazy gambles, and they're if they win, they're on the page bragging about it. If they lose, they're still bragging about it, then they can laugh at themselves over it. All right. So Wall Street Bets really kind of embraces the crazy side of finance. Now, I will say, in my role as an educator, I cannot, in good conscience, advise any of you to go on Wall Street Bets for investment tips. So just leaving that out there, okay? I'm not telling you guys that you should try to follow what's going on. In fact, I'm not here to give you kind of any investment advice of any sort. However, I will say this, okay? There is a certain charm, a certain kind of idiotic honesty that there is with Wall Street Bets that you don't usually get with finance. Okay. And let me explain to you what I mean. Okay. So, Wall Street just really loves to kind of wrap itself in this kind of air of grandiosity. They try to make themselves seem so powerful, so kind of looking down on everybody else, right? But you know what? That is all just an image, right? Fundamentally, there is no difference between a guy working at a big hedge fund and some guy on Reddit trading out of his basement. Okay? Sure, there's going to be a difference in the competency, difference in the level of experience, and of course, a big difference in the amount of money that they have to play with, right? But fundamentally, they're doing the same thing. They're sitting in front of their computer, they're watching some charts, taking in some information, and then placing bets on whether a line is going to go up or a line is going to go down. Okay? And so there is, a charming honesty to just how Wall Street Bets kind of reduces this act of trading, this act of investing that we'll put so much importance on in our society, right? We put the financial sector. We don't necessarily look up to them, right? They're not necessarily well liked, but they're given kind of the sense of awe and the sense of power. And Wall Street Bets does a good job of reducing that type of thing to what it really is, right? You're not necessarily gambling, but you're trying to make predictions and you're trying to put money behind those predictions, right? That's all it is, right? There's no difference between a guy on Reddit and a guy at a hedge fund. So now why GameStop? Well, of course, a lot of people on Reddit are also gamers, right? And GameStop is something that they would have better knowledge of than most people, right? So, and a lot of people on Wall Street Bets picked up on the fact that GameStop was being very heavily short sold. And so a lot of them started buying up shares and bragging about it, right? Bragging about, hey, let's all get in on GameStop. We got all these short sellers, but let's squeeze them. Let's really screw them over. Okay. And the more that they kind of hyped this up, the more people got on board, right? And so this idea coalesced, right? That everybody on Wall Street Bets could kind of unite, and that would force the big short sellers like Melvin Capital into a short squeeze, in which case they would lose a lot of money and be forced to abandon their position. Okay? So it's very important to point out here, there was no pretense that this operation was somehow done to bring GameStop stock to its true fundamental value, right? There was no argument, right? Nobody was trying to argue that GameStop was undervalued. Everybody kind of knew that GameStop was not really in a great position business-wise, but people on Wall Street Bets recognized that if they all got together and bought a bunch of shares, that they collectively could move the market. And this was something that nobody had ever thought of before, because it was not thought that the public could coordinate themselves to be able to manipulate the markets the same way that insiders could. So this is what the price chart looks like as of the time of recording this video. So like we mentioned, around January 12th, there's about $20 a share. It took a while to gather momentum, but as you can see, kind of around the 25th, 26th, especially on the 27th, everything started to go a little crazy, right? The price surged, peaked at almost $470 per share. Okay, so imagine, right? If you were to sell short at $20 a share and you had to buy back at $470 a share, right? Your losses would be more than 20 times the size of your initial position, okay? So if you were a short seller and you were shorting a lot of GameStop, what happened on these couple of days really made you nervous, right? You're really in trouble here, right? Because yes, maybe you were certain that the price was going to come down eventually, but you know, that's a lot of money to be losing for that belief. So here is the interesting part, because as you can see from this graph, right, the price peaked at 470, but on the 28th, the price actually fell quite a bit. So what happened here? Well, a lot of the rise of GameStop was driven by mobile trading apps like Robinhood. So Robinhood, like its name would suggest, right, is kind of marketing itself as a way for the average guy to steal from the rich and, you know, give to, well, the poor, which is yourself, right? So Robinhood was promising to make trading more accessible, and they did this in a couple of ways, right? There's no minimum deposit, and whenever you sign up, you get a free share. So what a lot of people were doing, and a lot of people on Wall Street Bets, but you know, as the word got out, as this trade became kind of more and more viral, so to speak, right? More people picked up on this, and more people decided to buy GameStop. A lot of them went to Robinhood and say, hey, I opened up a Robinhood account. I want my free share of GameStop. So what happened on the 28th, which is that once GameStop peaked, Robinhood and a lot of similar apps, a lot of brokerages abruptly halted trading for GameStop, not just for GameStop, but also on other kind of meme stocks like AMC and BlackBerry and Nokia. Basically, Wall Street Bets meme stocks were companies that kind of everybody else had abandoned, right? So, you know, AMC, well, you know, nobody's going to the movies anymore. BlackBerry, when's the last time you saw somebody with a BlackBerry, right? Nokia still exists, right? So there are these companies that everybody kind of left for dead, and therefore there was a lot of short interest. And Wall Street Bets, you know, these types of traders thought, well, if we all got together and we just bought up a bunch of these stocks, we can kind of push back against the hedge funds. And when Robinhood and other brokerages saw this, they're like, well, this could be troublesome. Let's just shut it down. And so the obvious reaction that a lot of people had to this was, well, this is coming, you know, this is like some order that's coming down from Wall Street, right? Because, hey, why are you shutting it down? What is wrong with GameStop becoming overvalued? This is just what the market is deciding it wants. Yeah, it's not necessarily based on fundamentals, but you know, a lot of stuff that happens in the stock market is not based on fundamentals, right? Who is Robinhood to judge what level of volatility is proper? So and there is some reason to believe that this was something that was forced on Robinhood and other brokerages by Wall Street because, well, a lot of these hedge funds had suffered a lot because of this trade. So we talked about Melvin Capital. Melvin Capital had to close the short position, and they needed a bailout of almost $3 billion just to stay afloat. So now we haven't reached the end of the story yet. So we'll see what happens tomorrow. We'll see what happens in the upcoming days. And, you know, we'll learn, but we'll definitely learn a lot one way or the other, right? So here's some open questions we can think about. Big question I want you guys to think about is what happened here? Was this just another pump and dump scheme? Is Reddit just like another Stratton Oakmont? They're just hyping up GameStop and then everybody's selling at the same time? Or is it really some kind of populist revolt against the corruption and greed of Wall Street? And what's going on? What's going to be the fallout of it all? Like in the aftermath of this, right? Especially Robinhood trying to shut down trading of GameStop, that drew like a rare bipartisan condemnation, right? It was everyone from Alexandria Ocasio-Cortez to Donald Trump Jr. was condemning Robinhood for kind of fixing the game, right? It's like, well, sure, maybe what these people are doing is manipulating the markets. But if manipulating the markets is wrong, well, we're going to have to go back and look at what these big hedge funds have been doing for decades, right? And I want you guys to think about, well, do you think this is going to lead to a longer term shift? Has the power on, in the stock market shifted away from these big institutional investors and toward smaller retail investors, because the retail investors have discovered that they can use platforms like Reddit to band together and move the market in a way that they couldn't before? And finally, what does the future hold for? Okay, this one is a joke. Listen, GameStop is screwed no matter what. I'm absolutely sure about this. Okay, but like we said at the beginning, it doesn't matter, right? GameStop is not important here, right? The actual company, the fundamentals of the stock don't matter, right? It was a window that opened up a lot of questions, right? And kind of zooming out, looking at the bigger picture is a lot more interesting, just focusing on whether the price of GameStop reflects its fundamental value. That's not that interesting, right? All right, well, so that's that for this lecture. I will probably re-record this near the end of the term after these events have had a chance to kind of play out, and we'll see. We'll see what happened. All right. Okay.